Hi, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, October 25th, 2025. Hey, I hope you're doing well. I hope you had a good trading week. I hope you're having a nice weekend, and I appreciate you coming to my Weekend Review podcast. I hope it is going to be helpful for you. The format for today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions, all the trades that I made last week. We're going to talk about when I entered the trades, why I entered the trades, and most importantly, how I am going to manage the trades going forward. In general, with trading, it's very important that you are patient. You're waiting for a setup with a confluence and a combination of support levels, resistance levels if you're short, and multiple entry signals. At that point, you need to position size correctly, and you need to have a plan of exactly what you are going to do. So, like I said in the podcast here, we'll talk about the trades that I entered, how I position size, how I place my two stops, my emergency stop, my end of bar stop, how I take partial profits if the trade goes my way, and then ultimately how I am going to exit the position, whether it's a gain or a loss. So I have a lot of positions to cover today, of existing positions, some new positions I got in last week, some positions that I got out. But like I said, I hope it's going to be helpful for you to kind of get inside my mind as far as how I view trading and setups and processes. And if it is helpful for you, I really would appreciate it if you could hit the thumbs up button. If you could subscribe to the channel, that would be great as well. But it lets YouTube know that there's some valuable content here. So, all right. So after we go through the trades, we're going to talk a little bit about trader psychology, always the most important skill, just the ability to create a plan and to follow the plan precisely. Over the long run, that is how you are going to be a profitable trader. And, it's very important to follow that process. I've been trading for over 30 years now. And I'll just tell you, when I follow the process, win or lose in the long run, that's how I make the money. But if I get in there and be emotional with my trades, impulsive with my trades, it's just a rocky road. So anyway, there's one thing that I want to try to convey to you today is get yourself a process that incorporates good trading principles, but more importantly, you have to follow it. So that's what I'm going to talk about in trading psychology. After that, I have gone down through my watch list and I have identified some potential trades for next week. They're not where they need to be yet, but if they get there, I will consider taking the trade. So I hope that will be helpful for you to kind of see my process of looking at potential trades for next week. So let's go ahead, run the U.S. legal disclaimer, get that out of the way quickly, and we'll come back and we'll get started. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, thanks for holding through that with me, and let's get started on the first trade. I have a lot of trades to show you, so if you like seeing multiple trades, today is your day. It seems like I own every stock in the world, but very rarely do I have this many positions, but they've worked out. So just continue to follow the rules, continue to follow the process. So this is Meta, M-E-T-A. I did enter Meta here on the 7th of October at 713.07. Now, why did I enter here? So I used a lot of different strategies. This one is an order block. You see this green block here? This is an order block, and I use different strategies, but a lot of them revolve around order blocks. So I'll show you why. So let's first talk about what an order block is. An order block, to begin with, you need a swing low. A swing low just means that you have a higher low to the left and a higher low to the right. So here's your swing low, higher low to the left, higher low to the right, followed by a swing high. A swing high, you have a lower high to the left and a lower high to the right, okay? So you have a swing low, you have a swing high. Now you need another swing low that's lower than the first swing low. And then when you have that in place, if you can go above the first swing high, now you can identify an order block. So we have a swing low, we have a swing high, we have a lower swing low. This bar definitely took us above this high. So that means we have changed structure to the upside. Now, when you change structure to the upside, I want to buy dips back in the order block. So swing low, swing high, lower swing low, market structure change. As soon as you change market structure to the upside, if you identify the lowest closing bar before market structure change, the high and the low of that bar is the order block, and you move that into the future. Now, if you come back into the order block, those are the places that I'm looking for entries. So if we look at meta here, way up here at the highs, well, you can, probably rightly say, you know what, smart money, this is in hindsight, but smart money was buying down here when in the future it goes up here, right? So that order block, I consider the order block a smart money area. So in the future, if we come back to that smart money area, does it mean that it has to go up again from there? No, it doesn't. Things can change. But more times than not, if you come back to that previous smart money area or that order block, that is the place to think about looking for a trade. So there's multiple ways to enter a trade with an order block. You can have a rejection of the high of the order block, which just means you come into the order block and then you close above it. You can enter with rejection of the low of the order block, meaning it went below the order block and then closed back in it. Or if you have major moving averages inside the order block, and there's some other things too, and I'll show you. So, but this is the order block that started back on 7:30. Smart money area. Again, in the future, if we come back to the smart money area, that's where I want to be looking. So I entered here at 7:13.07 because we rejected the high of the order block. You see how we poked our head in it during the day, but at close we rejected it. So that's why I entered. So I want to talk about position sizing. Very important, everybody. And let me just show you the process that I use. It's very simple. It takes a lot of things into account. I always talk about position sizing based upon volatility. And if you use the 2 ATR in your formulation, it does it automatically. So the first thing that I look at is how much do I have in my trading account? Let's say I have $100,000 in my trading account. Well, I simply take 1% of however much I have in my trading account, but let's just say $100,000. 1% is $1,000. Now, all I do is I take that $1,000 number, I divide it by the value of the 2 ATR. Right now, the value of the 2 ATR is $32.98. So divided by $32.98 simply tells me to buy 30.32 shares, simply tells me to buy 30 shares. Now, the 2 ATR, and ATR means average true range, how much is this expected to move in one particular day? I take twice that because it shouldn't move that amount. So that's why I use that. But this 2 ATR is, if volatility is high, this number is going to be larger, and therefore the amount of shares you buy is going to be smaller. If this number is low, volatility is lower, and I'm going to buy more shares. So it's very important to base your position size based upon what the volatility is doing. Okay, so 1% of my trading account, $100,000, 1% is $1,000 divided by 32.98. My formula tells me, based upon the volatility and the amount of money that I have in my account, 30 shares is the correct amount of shares. Okay, now, as soon as I know how many shares I'm going to buy, I immediately take my entry price minus the 2 ATR. So 713 minus the 2 ATR amount, this is where I put my emergency stop, because if I have 30 shares and it moves $32.98, how much have I lost? I've lost 1% of my account because we just did the math, right? I don't want to lose more than 1% of my account on any one trade. But the good news is this emergency stop, this is pretty much the worst case scenario. There could be some times where a gap below, but most of the time, that's about what your maximum allowed loss is going to be. But the good news is that the maximum allowed loss is only going to happen about 5% of the time. The other 95% of the time, if I have a loss, it is going to be my end of bar stop. So I always use two stops: emergency stop, end of bar stop. Now, an end of bar stop could be many things. It could be a close below a major moving average. It could be a close below a 30 RSI. In this particular case, I don't have any moving averages to key off of in the order block, so I made my own. And so let me take you over here to the bar on 10/6/25. Do you see the big up bar? Big, massive reversal up bar. If you have a big up bar like this, that's generally larger than 1 ATR, if you come back to halfway of that bar, that will act, not all the time, but more times than not, that halfway will act as support. So when I enter the trade here, of course, I have my emergency stop 2 ATRs below, but my end of bar stop is just simply a close below halfway, because it shouldn't close below here. And if it does, okay, it might be foretelling some issues with the stock in the future. So we have the order block. We rejected the high of the order block. I saw the big up bar. I placed the halfway stop here. This is the green line. And all this means that in the future, if I close below this midpoint, I'm going to get out of the trade. But you can see this stop level is a lot closer than my 2 ATR stop. That's why I'm saying 95% of the time, if you have if I have a losing trade, it's not going to be because I hit my emergency stop. It does happen sometimes, but majority of the time, it's going to be because it closed below the end of bar stop. All right. So rejection of the high of the order block, entered at 713.07. I position size like we just discussed. I place my emergency stop 2 ATRs below, and my end of bar stop is a close below the midpoint of the bar on 10/6, which is 701.90. Now, the next thing I do after I enter, I look for the value of the 1.5. The 1.5 is 24.73. I place this. I take my entry price plus the 1.5 value and I place it above, right? I place the emergency stop 2 ATRs below, but now I place the trailing stop level 1.5 ATRs above my entry. If I get to this trailing stop level, now I go into trailing stop mode. You've probably heard in trading, once the trade starts moving your way, you want to tighten up your stops. Well, this is exactly what the trailing stop level, what I use with trailing stop level does. If it moves up 1.5 ATRs, then obviously I have a nice trade going. I want to tighten everything up, and the way that I do that is that now in the future, if it gets to trailing stop level, if I have a close below a previous bar's low, I sell half. Hasn't happened yet on Meta, but by selling half, that just by default tightens, it moves everything. It moves everything up. So, okay, now everything I've talked about so far, emergency stops, end of bar stops, going into trailing stop mode, these are all defensive maneuvers, which means that if the market I'm trading moves against me, I have to take action. But I also want to play offense in my trading, not just defense. And I do this by taking partial profits if it moves a certain amount from the previous bar's close. So I'm in Meta right now. I'll show you exactly how to do it. It's not hard at all. I've used this for years and it works really well. All I do is I take the closing price of the day. Right now it's 738.36. And all I do is I take that amount and now I go over to the 0.45 ATR. The 0.45 ATR is $7.42. So I add the closing price plus the 0.45 ATR of 742. Now I have my first profit target for Monday is 745.78. And I put a limit order in for 10% of however many shares I went into the day with. If I went in with 10 shares, I place one share, 10%, right? 10% of 10 is 1, at that first profit target. And I do it 2 more times. I take the first profit target, 745.78. Again, I add the 0.45 to it, plus 742. My second profit target for Monday is 753.32, 753.20, excuse me. And again, if I hit the first profit target, I sell 1 share. If I hit the second profit target, I sell another share, and I do it 1 more time. I take the second profit target, 753.20 plus 742, and my third profit target for Monday is 760.62. And I redo this every day, right? And so, you know, if I hit a few profit targets, I'm going to have less shares. And so the next day, I'm going to take 10% of less shares. All right. So those are kind of the basics. Now let's go through the trade. Okay. Rejection of the high of the order block. Enter the position size correctly. Enter the trade. Place my emergency stop 2 ATRs below. My end of bar stop on this particular trade is a close below halfway of the previous up bar. I place my 1.5 ATR trailing stop level above, and away we go. The next day, no profit targets, but did it close below my end of bar stop? No. Next day, nice up bar. I did hit some profit targets. Are we to trailing stop level? Not yet. Next day, down. But did it close above my end of bar stop halfway of that bar? Yes, it did. Next bar up, where I did hit some profit targets. Next bar down again, did test the halfway. Remember, at that halfway, more times than not, it will have support. Did it test it? Yes. Did it close back above it? Yes. Did it keep me in the trade? Yes. Next day up, profit target. Then we came down. Here we had kind of a nice little break to the upside where I continued to take profit targets. And in the last few days, it's held steady, but it hasn't really done much. So this particular, but I am in trailing stop mode, but you see we have not had a close below previous bar's low. So this trade doing quite well, up 3.36%. We do have earnings, everybody, on 10/29/25. I never hold through earnings. So regardless of where Meta is before earnings, I will exit. Whether I'm at a small loss, whether I'm a gain, in the middle, doesn't matter. I never hold through earnings. Holding through earnings really is a gamble. You never really know what's going to happen. And as traders, our number one responsibility is preservation of capital. And the worst way to lose a lot of money is to have bad earnings and have the stock go down. I'll show you some examples actually later in the podcast. But again, so before earnings, I will exit the trade regardless of the profit and loss on the trade. But Meta doing pretty good so far, up 3.36%. Disney. Okay, I did enter Disney here on the 16th of October at 109.86. Why? Well, we have an order block from the past. Remember, if we come down into the order block, reject the order block, or reject your major moving average inside the order block, I am going to exit the trade. So I got long here on the 16th of October, 109.86, because it rejected the 200-day moving average, the black line, inside the order block. So as soon as I got long, I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200 or a close below this black line. So if I'm wrong, I could be wrong really small. If I'm right, I can have a nice trade like I have. So as soon as I entered, I placed my 1.5 ATR trailing stop level above, and away we go. I know exactly what I'm going to do in this trade regardless of what Disney does. I don't have to predict anything. I just have rule base that tells me what to do. Next day, fortunately, moved up my way, hit some profit targets. Next day, up again, profit targets. Next day, up very strong, hit multiple profit targets, and now I am in trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a close below a previous bar's low, I'm going to get out of half. Next day was down. Next day almost closed under, but it didn't. Friday, we finally had our first close below a previous bar's low. After reaching trailing stop level, I took half of the position off and locked in a gain of 1.67% on half of the position. Going forward, if it closes under the 200-day moving average, I'll simply get out. If it continues to move up, I will take partial profits. If we get into the 65 RSI level up here, then I'm going to use a close below the 5 EMA as my trailing stop. If it zooms past 65 and gets to the 70 RSI and rejects the 70 RSI, then I take more off as well and other rules to completely get out of the trade, but we're not there yet. But the remaining shares on Disney up 1.67%. Pfizer, PFE. Okay, Pfizer again, order block. Why order block? Swing low, swing high, lower swing low. Huge market structure change by taking out the swing high. This defines the order block going forward. If we get back into the order block, I'm going to be looking to buy. And that's exactly what I did here on the 17th of October. Because we rejected the high of the order block, we also closed above the black line, which is the 200-day moving average. I got long here 24.51. I position size as I should based upon the volatility of the market using the 2 ATR. I placed my emergency stop 2 ATRs below. My end of bar stop, very close, simply a close below this 200-day moving average. I placed my 1.5 trailing stop level above, and it hasn't really done much, right? It's not a trailing stop level, hasn't moved up for me. I did hit one profit target on this day when it moved up. So offensively, I took a little profit into that bar to reduce the position size a little bit. So really hasn't done much, but we have a lot of sideways motion here. And there's one rule in trading: sideways motion leads to trends. Thing is, we don't know if the trend is up or down. Don't know, right? It'd be great if it was up, but also could be down. So that's why I have to have that 200-day moving average there as my stop. So doing okay, up 1.13% on Pfizer. USO. All right, USO has been a really nice trade. I did enter USO again because of an order block from the past. This is kind of a confluence, everybody. Deep dip buys. I use deep dip buys. I teach deep dip buys, but I'm combining with this one, I'm combining a deep dip buy with an order block. The 30 RSI level is a very important oversold level, and large financial institutions, savvy traders tend to come in with a rejection of the 30 RSI. So on this particular day, we basically got right to the 30 RSI. So we got right to that kind of important level. Buyers came in. So on this day, not only did we basically bounce at the 30 RSI, but we also rejected the high of the order block. And again, what does that mean? It means that during the day, it was in the order block, but it closed above it. So it rejected it. So I got long oil here at 67.81. I position size correctly. I placed my emergency stop 2 ATRs below. And because this order block is pretty thin order block, good risk to reward ratio, my end of bar stops a close below the order block at 66.30. Okay, So my end of bar stop's 2 ATRs below. Excuse me, my emergency stop's 2 ATRs below. My end of bar stop's a close below the order block. I placed my 1.5 ATR trailing stop level above. Next day, took off nicely right off of out of the bat. Did hit a profit target. Next day, big up on oil. Again, hit multiple profit targets. Thursday, huge day up. Hit many. I think I hit 4 profit targets. I only placed 3, but if during the day I've hit 3 and it's more, I enter more in. And then Friday it was down just a little bit. So I am in trailing stop mode, but we have not had a close below a previous bar's low, so I'm not doing anything. We're at a 55.65 RSI. Again, if we get to at least a 65 RSI, now the 5 EMA will come in as my trailing stop level. I'll also be looking for how it reacts around the 70 RSI. And so far, this particular trade doing quite well, up 7.21%. FedEx. All right, so FedEx is a short. I've talked about order blocks, bullish order blocks that I put in green. There's also such things as bearish order blocks. Bearish order blocks are exactly the opposite. We have a swing high, followed by a swing low, followed by a higher swing high. And then in the future, if we take out that swing low, like we did, now it changes market structure from a bullish market structure to a bearish market structure. And once it changes structure to a bearish market structure, now I can identify the bearish order block. It's the highest up bar close before market structure change. Now the high and the low of this area moving into the future is the place that I want to be looking to short. Because if you, after this big, huge move down, you can look back in the future and go, oh yeah, that was not smart money that was buying up there clearly because we just had this big sell-off. So if we come back into the dumb money area, I may want to be looking for a short. Well, that's exactly what I did here on the 21st of October for 2 reasons. One, we rejected the bottom of the order block. We went in it during the day, closed below it. The other reason, and we're using trend lines here, is that when you connect these lows with this swing low, this was a bullish trend line, but we broke the trend line. And if you break a bullish trend line to the downside, if you then recover and get back to that trend line, but underneath it instead of over it, now it is resistance. So on the day that I took the trade, the short at 242.93, 2 things happened. We rejected the trend line. We closed below we rejected the bottom of the order block. So I got short here, 242.93. Same thing. I position size. I placed my emergency stop 2 ATRs above. My end of bar stop on this trade, and this is going to change day by day because these trend lines will go out into time. My end of bar stop on this trade is simply a close back over this trend line. I placed my 1.5 ATR trailing stop level below. Remember, I'm short now. So if I get to trailing stop level, now I need to tighten up my stop with a close above a previous bar's high because I'm short. Well, I entered here, the next day down. Great. Hit some profit targets. Next day down again. Hit more profit targets to the downside, but I did not quite get to trailing stop mode, so I'm not in trailing stop mode yet. And then, of course, Friday, it was up a little bit. So this trade's doing okay. It's up about 3/4 of a point, not a lot, but do you see why it was important that I took the partial profits during the day once the market gave them to me, right? So I'm reducing my position size. I locked in some profits lower. And so remaining shares up 0.75% on the short. Again, my end of bar stop is a close above this trend line. NVIDIA. All right, had a nice trade on NVIDIA. Oh, yeah, I do want to point that out to you. But so this is an order block trade. Where's the order block? Swing low, swing high in the same bar, lower swing low, market structure change, lowest bar close before market structure change, the high and the low, bring it out into the future. Well, this particular trade, I do have a moving average that I can key off, and that's why I got long here on 1015 at 179.92, because during the day it went below the 50, the gray line, closed above the 50. Okay, so I enter, position size correctly. I place my emergency stop 2 ATRs below my end of bar stop, simply a close below this 50. See how close I am to it anyway? That's the key. Getting in when you're very close to your end of bar stop. So if you're wrong, you can be wrong very small. Place my 1.5 ATR trailing stop level above, and away we go. The next day, up, profit target. Next day, nothing. Next day, nothing, nothing. Here, on this day, on the 22nd, we did actually get ourselves below the 50, didn't we? But we closed back above. That's what kept me in the trade. Next bar, up, profit target. And again, profit target on Friday as well. So this particular trade doing pretty good, up 3.38%. Okay. Okay, CarMax. I have not traded CarMax in a million years. I have been kind of following the chart because I have a friend of mine that's been in CarMax, and we've been looking at that trade. But I did enter CarMax on Friday at 44.26. So a couple reasons why. We have this big, wide order block, and you can see CarMax, for the most part, has respected the bottom of this order block. But this is kind of a strange trade and setup because we have two things going on. One, we did reject the bottom of the order block. That is legitimate by itself. But we also have what is called a higher low V2. Let me bring your attention to this green line and this green line. Okay, this is called the value zone. Whenever price is inside of the value zone, there's particular trade setups that I can take. So one of the reasons I took this trade is because what we have is called a higher low V2. So the first requirement for a higher low V2 in the value zone is that you have to close below the value zone. Well, clearly we have closed below the value zone for a long time. The second requirement is that you have to go back in the value zone, which is exactly what happened. We came back in the value zone. The third requirement is that you have to have a pullback followed by a V1 or a V2 that closes in the value zone. So V1s and V2s, if you'd like to learn more about these, just go to my YouTube channel, type in V1, V2s, and you'll see I have a whole video there. But this is a V2. A V2 consists of 3 bars: bar 1, bar 2, bar 3. The requirement is that bar 2 has to go below bar 1's low, and then bar 3 has to close above bar 1's close. So one more time. Bar 2 has to go below the low. Bar 3 has to close above bar 1's close. Well, that's exactly what happened. Now, when you have a V1 or a V2, your end of bar stop is a close below halfway of the washout bar. Bar 2 is the washout bar because it washes out, or in other words, goes below bar 1's low. The reason that I took this trade was interesting is that the halfway of the washout bar dovetails perfectly with the bottom of the order block. Make sense? So that's why I took the trade. It's a combination of a rejection of the bottom of the order block and a higher low V2. I entered 44.26, which is exactly where it's at. I positioned the size correctly. I placed my emergency stop 2 ATRs below. I placed my 1.5 ATR trailing stop level 1.5 above. And who knows what's going to happen, but I know exactly what's going to happen. If it moves up, I'm going to take partial profits. If it gets to my trailing stop level, I'm going to get into trailing stop mode. If it goes down and closes below halfway of the washout bar, which is also the bottom of the order block, at 43.04, I'll simply exit for a loss, or if it really goes down and hits my emergency stop, I'm simply out of the trade. That's the best I can do, right? I have a plan laid out. I know exactly what I'm going to do, and this is what I would suggest to you. Get yourself a process, a good trading principle process, and then follow that. That's how you're going to get the money. So this trade completely break even at the moment. Okay, so those are all the open positions. Let's talk about some of the daily positions that I closed out. I did buy McDonald's. This was a really nice trade. I did buy McDonald's here on the 9th of October at 294.30. Why? Two reasons. One, we rejected the bottom of the order block. Two, we basically rejected the 30 RSI, right? Those are two primary entry signals. So I entered 294.30. I placed my emergency stop 2 ATRs below. My end of bar stop is just simply a close below the bottom of the order block. See how close that is? To the upside, I placed my 1.5 ATR trailing stop level above, and away we go. Next day, as soon as it rejected that order block, took off to the upside, hit multiple profit targets. Next day, up again, hit a profit target into trailing stop mode. Next day, up again, continued to sell some shares into that strength. Next day, up again, more profit targets. And then we kind of dripped our way up here, had a profit target on this day. Now, here, more profit targets at the top. Now, you've heard me talk about this before, but on this particular day, we got ourselves into a 65 RSI reading. If you're 65 or higher, you're moving up pretty high. So at this point now, I am bringing in the 5 EMA, which is this thin blue line. So if I ever hit 65 RSI and then I get a close below the 5 EMA, that is my signal to completely get out of the trade. And on Thursday, we did close below the 5 EMA. I did exit the trade completely with the shares that I have remaining. Remember, I'm scaling out on the way, so I had fewer shares to get out of here than when I entered because I scaled out. But the remaining shares that I got out of on McDonald's up 4.12%. And so that's it. I'm out of the trade. I closed out the trade Friday down again. So I'm glad I got out. So the remaining shares, I locked in all the profits, got out of the trade for a gain of 4.12%. Netflix. Okay, this is interesting. Some good teaching examples here. So I had two trades on Netflix. The first trade happened here on the 6th of October. Why? Long trade. Well, it rejected the bottom of the order block and it also rejected the trend line. We have a swing low here. We have a swing low here. We connect them. This is called the megaphone trend line, where you connect the bottoms, you bring it out into the future. If in the future you reject that projected trend line here and reject it, it's a pretty good place to get in addition to rejecting the bottom of the order block and being in the order block. So I got in Netflix 1162.87. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the trend line. I placed my 1.5 ATR trailing stop level above, and away we go. Right away, it took off. Multiple profit targets. Next day, more profit targets. Got to trailing stop level. Next day, up again. Profit target. Okay, I'm in trailing stop mode. And the next day here, as we got into the bearish order block, look how it reacted to the bearish order block, immediately down. But then here we had on the 13th, we had our first close below a previous bar's low after reaching trailing stop level. What did I do? I took off half of the remaining shares that I had for a gain of 4.66%. Okay. Then we continued down, but I stayed in the trade because my rules told me to. Next day up, more profit targets. Next day up, many profit targets on this big move up. And then I exited the trade here on the 21st. Why? Because the next day or that afternoon, earnings. I'm not going to stay in through earnings. So I exited the remaining shares that I had before earnings for a gain of 6.30%. And then look what happened on earnings, everybody. Am I glad that I got out? Yeah, it was down 10%. But on this particular day after earnings, remember, I got out the day before. On this particular day, I re-entered the trade. Why? Well, we came down to a lower order block and we rejected the 200-day moving average. So I reset up the trade, brand new trade, full position size, place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200. Well, that happened the next day. It did close below the 200. So this is a really good example. So this was a very small loss, 0.31%, but this is a good example of being wrong, but being wrong very small, right? So good teaching moment on Netflix here about the importance of getting out before earnings, right? But that was a great trade. The remaining shares up 6.3%. But again, I took another shot because it was a legitimate entry, rejection of the 200 in an order block, but it just didn't work out. So it closed below. So I just got out. Am I glad that I got out there? I did, because look, it was down 1.7% on Friday. So the remaining shares on the first long trade up 6.3%, and then the second trade did have a loss of 0.31%. Okay, let's go to Coca-Cola. So Coca-Cola is the opposite, and this can happen with earnings. But let's first talk about why I got into the trade. I got into the trade on the 29th of September. Why? Okay, this is one of those order block trend line combinations. So remember, these megaphone trend lines swing low, you find another swing low, you connect those, the trend line goes out into the future, and in the future, if you do get to that third low, very often you'll have a reaction and it will go up. Remember, we're in an order block. That's why this was important to me, looking for this trend line. You can find trend lines all over the place. I'm not going to take just a break of a trend line for no reason, but being that it's in an order block, that's why I took it. And so here on this particular day, we rejected this megaphone trend line, meaning that we were below it during the day, then we closed above it. I got long 66.03. I placed my emergency stop 2 ATRs below, as always. My end of bar stop is simply a close below the trend line. Place my 1.5 ATR trailing stop level above, and then we just kind of moved our way up. On the days that we moved up strongly, I took some partial profits, and then finally here on the 10th of October, we got to trailing stop level. Doesn't mean I do anything, it just means now in the future, if I have a close below previous bar's low, I'm going to get out of half. Next day was way below, but closed above, kept me in the trade. Next day up again, up again, up again, profit targets. And then I exited here on the 20th. Why? Because we had earnings the next day. So I exited the remaining shares of Coca-Cola for a gain of 3.54%. But earnings cut both ways. Netflix, I got out, it went down 10%. Coca-Cola, I also have to get out, but it rocketed up. So go figure. You never really know, right? But I'm still glad the remaining shares on this particular trade up 3.54%. Okay, so those are all the three daily positions that I exited. So we went over the current positions and the gains and losses on those, the closed positions, the gains and losses on those. And now let's go to the weeklies. What I just showed you were daily bars, but I also trade the weekly bars because I think weekly bars are great. And I think it's good to trade different time frames. So XLV on the weekly, each bar is a week. I did enter XLV here on the 8th of August. Why? Well, we rejected the high of the order block. We rejected the 300-day moving average. If you've been watching the podcast for a while, I talked about XLV for weeks and weeks and weeks, saying I needed to come down here, test this level, That's when I'll get in. If it doesn't get there, I'm not going to take the trade. Well, it did finally get there on 8/8/25. I got in at 130.07 on Friday, because weekly bars close on Friday. I position size. I place my emergency stop 2 ATRs below, as always. And then my end of bar stop is simply a close below the 300-week moving average. See how close we are there? To the upside, I place my 1.5 ATR trailing stop level above. And away we go. Next bar, as soon as it rejected that order block, as soon as it rejected the 300, it changed directions and moved up strongly, which I'm grateful, right? Multiple profit targets on this week up. Next week, another profit target, got to trailing stop level. Then we moved sideways for about a month. Here was our first close below a previous bar's low after reaching trailing stop level. I exited half of the position on XLV for a gain of 3.99%. And then the next week, huge up, many profit targets on this one. Another profit target here this week. The remaining shares that I have on this XLV weekly trade are up 10.86%. We are to 61 RSI. So if we get to the 65 RSI, if we have one more up week, very likely we'll get to a 65 RSI. Now the 5 EMA will come into play. That will be my trailing stop level. If we close below that 5 EMA, just get out of the trade. Alternatively, if it goes up beyond the 65 and rejects the 70 RSI, though that's the entries where, or the situation where I will be exiting the entire trade. All right. So remaining shares on the XLV weekly trade up 10.86%. UUP, which is the dollar, surprise, surprise, another order block, major moving average rejection. I did enter here on 7/11/2025. Why? Two reasons. We had a close under, close over the 200. That's a deep dip buy. And the second reason, we closed in the order block, closed back above it. That's a rejection of the high of the order block. So two primary reasons to get into the trade. I got in at 27.21. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. I placed my 1.5 ATR trailing stop level, 1.5 ATRs above. Next week, we went up. Can't remember if that was a profit target or not. Next week, we went down, tested the 200, but closed above it. That kept me in the trade. Next week, up big, multiple profit targets. Also got to trailing stop level. 2 weeks later, we had our first close below the previous bar's low. What do? Take off half the position, which I did for a gain of 0.55%. We moved sideways for about a month. Here on the 19th, during the week, we closed below, but closed back above. That kept me in the trade. Next week up, profit target. Next week, nothing. Next week up, nice profit targets. I think multiple. And the remaining shares that I have on the UUP position, pretty good. It's a lot on a currency, up 2.51%. TLT, I've been in this trade for 125 years. Well, I guess I've been in it 10 months. Why? Well, TLT. I entered TLT back here on January 17th, 25. Why? Rejection of the high of the order block plus a V1. I got in 87.20. Placed my emergency stop 2 ATRs below. My end of bar stops closed below the low of the order block. I placed my 1.5 ATR trailing stop level above. And then for about a month and a half, we just went straight up after that. Hit multiple profit targets. Here on the 28th, big up bar, multiple profit targets. Moved sideways for a while. Here on the 4th, sold into that strength, thankfully. And then we had the big, huge sell-off, which did close below a previous bar's low after reaching trailing stop level. Thank gosh I sold into this strength while I had it, right? It's the importance of taking partial profits. But then here I had to exit half the position for a loss of 0.58%. Not bad. And then we we moved down, we moved up, but we never closed below the low of the order block. On bars where it did move up strongly, I took partial profits. And then finally, in the last few months, we have really rallied on TLT. So the remaining shares that I have on the TLT trade, doing pretty good, up 4.63%. But the one thing that I've been saying, TLT pays a monthly dividend, 4%, about approximately 4% per year, but it pays it on a monthly basis. So I've been in this trade for 10 months. And so not only the remaining shares have had a gain of 4.63%, but also have had the dividend along the way. We are to 6141 RSI. If TLT gets up to 65 RSI, then the 5 EMA will come into play. And then if we close below that 5 EMA, that will be the exit of the trade. Thank goodness, because this is the longest trade I've been in for years. I'm tired of talking about it. You're probably tired of hearing it. But so I'm kind of rooting that it's going to get to 65 and then close below the 5 so we don't have to talk about it anymore. But I did, really want to show you that some trades can go on for a long time. But all in all, it's been nice, positive trade. So really, I can't complain. Okay, last but not least, thankfully, is Amazon. Amazon on the weekly has been a short. Okay, this is a bearish order block. Why? Swing high, swing low, higher swing high, market structure change to the downside. When you look, when the market's all the way down here and you look at the people that bought up here, is your thinking? Well, that really wasn't smart money that bought there because it preceded a big down move. So therefore, if you come back into the bearish order block, or in other words, into the quote dumb money area, that's where I want to look for a short. Now, I've talked about having a big up bar and it coming back to halfway, there should be some support. Well, the opposite is true. If you have a big down bar and you rally back to halfway, that's where you're going to find resistance. Look at this back here on 214.25. It's exactly what happened. Big down bar. We did rally back to halfway, collapse. So this is where I keyed my short off of, was this halfway of this big down bar going into the future. So I got short Amazon at 230.90 because at the closing bar of this weekly bar on a Friday, it rejected the 233.70 level that I just mentioned, and that happened inside a bearish order block. So I got short 230.90. I position size. I placed my emergency stop 2 ATRs above. I placed my trailing stop level 1.5 ATRs below. And my end of bar stop is simply a close above 233.70. So I'm very close to my stop anyway. So the next week, it went down. I hit a profit target, locked some profit in, reduced the position size. Then it moved up, but for the next month, it tried to close above this halfway mark. Couldn't do it. And then finally, we kind of started to pull back to the downside where I hit a profit target. And then a couple of weeks sideways. And then 2 weeks ago, we did go down enough for me to hit a profit target. And then this week, up, right? So the remaining shares that I have on this particular short trade, up 3.13%. We do have earnings coming next week. And so therefore, what am I going to do? I don't hold through earnings. So whether it's a gain, a loss, break even, doesn't matter. I will exit the position. So there you go. The short on Amazon, remaining shares up 3.13%. So I hope that was helpful. I mean, we went through a lot of different trades, both long, both short, different setups, but you can see that the key to consistent, profitable trading, everybody, is being very impatient with your losers and having a process and being very patient with your winners, right? I showed you some gains, I showed you some losses, but what you have to really keep away from those large losses, right? And fortunately, I I didn't have to show you many large losses, right? They were very small losses with some ones that had very big gains. So this is what's super important about trading, getting yourself a process and then following that process. Okay, so before we get on to the trades for next week, let's talk a little bit about trader psychology for just a couple minutes. Okay, this is from Casper. I don't know who Casper is. I saw this on X and I thought this is a really great post. So I did want to share it with you. And so thanks, Casper, for sharing this great trade. You can follow Casper at Casper _ SMC. So give him a look, give him a follow, because really this is a great, great post. And I want to share the relevance of this. Let's see what Casper has to say. Traders don't become profitable when they're ready. They become profitable when they're disgusted. Disgusted at the lack of discipline, the emotional decisions, the blown accounts. Once you reach the I'm done, I can't take this anymore, that's when your breakthrough comes. I have experienced this myself. I see this with traders all the time. Just to give you a little bit of history on me, I started a chewing gum company in my early 20s. It was very successful. We went public. My company is the company that developed the product Zicam. I don't know if you remember Zicam, the cold remedy. So at a very early age, my company went public. I made a lot of money. I stepped away from the company after this and I was basically retired. Like, what am I going to do? What did I do? I found trading. But the problem is, I didn't know jack about trading. I was very young, had a lot of money, had a lot of testosterone, but I didn't know what the hell I was doing. I had a month, in a couple months, I lost like $1 million, right? And obviously, I was disgusted. Okay. And I thought to myself, you know what? I'm either going to have to learn to trade correctly or I have to quit. I decided I'm going to learn correctly. I reached out to all the famous trading people, all the famous instructors, authors, and I said, look, I'll pay you whatever it takes. I want you to teach me how to trade correctly. I did this with 5 different kind of world renowned traders, and I learned from them how I trade now. What I'm teaching you now is what I have learned from all these traders through the years. But in order to get me to that point, I had to become disgusted. If you are in a position right now, like Casper says, that you're disgusted with disciplined emotional decisions, blown accounts, you're either going to have to quit or you're going to have to get better, right? It's one of the two. And I hope that you learn how to trade correctly. But if you're not at rock bottom, you don't really care. The lack of discipline and the emotional swings and decisions that you make, it doesn't really affect you. But if it gets to the point financially where it's going to affect you, that's when, like I said, you've got to quit or you've got to get better. So if you are in this position, learn a good trading process and follow it, because if you want to stay in the game, you have to. And that's what I have found. When push comes to shove, that's about the only time that people really start getting a process and following it, is when push comes to shove. And for you others that are still have a lack of discipline and the emotional decisions and the blown count, if you have enough money, I guess you don't care yet. But if you get to that crunch point to where you care, that's when you're going to change your behavior, right? Just like you always hear people have to hit rock bottom before they change. It's exactly the same with trading. So let's talk about it one more time. Traders don't become profitable when they're ready. They become profitable when they're disgusted. Disgust at lack of discipline, the emotional decisions, the blown accounts. Once you reach the I'm done, I can't take this anymore, that's when your breakthrough comes. So if you're in this position where you're done, there might be some light at the end of the tunnel because you're ready to change. For the rest of you that you still don't care and you're losing money, Why wait until crunch time? Why wait until you're almost done? Change it now, right? I can help you. There's other people that can help you, but change it now. But thank you, Casper. Please give Casper a follow at Casper_SMC. Great post, Casper. Thank you very much. All right. So listen, let's get on to the trades, potential trades for next week. Interestingly enough, usually I have 6, 7, 8, 10, 12 different potential trades for the upcoming week. This week on the daily, I have 3, and on the weekly, I have 1. There's just not a lot of markets that are appealing to me. Plus, I'm long, it seems like everything in the market anyway at the moment, right? Through the trades that we just discussed. But even with these 3 potential symbols for next week, Monday, all 3 of these could trigger, right? Does that mean I would take all 3? No, I only take 1 trade per day. I don't care if I have 10 candidates, I have to narrow it down to the best one. How do I do that? Well, I score these setups and I give them points essentially. Right? I give them a report card. If they have 1 signal, I give them a score of 1. If they have 2, I give them 2, 3, so on, right? But there's many different things I look at. How many entry signals, what what's the risk to reward ratio on the trade, what is the higher time frame looking like, the relative strength, right? Is this stronger than the rest of the market? Okay, that gets a bonus point as long as it still has a good risk to reward ratio. So this is important. The devil's in the details, and this is what I teach my students. And by the way, I teach a one-on-one course, 20-hour course. I teach you everything I've used for the last 30 years. I've taught people all over the world, from absolute beginners all the way up to hedge funds, right? I consult with hedge funds every month. And this is what I will teach you. I will teach you a process that you can use, a process to follow that includes all the proper trading principles that I discussed: good risk reward ratios, position sizing, taking partial profits, right? But so, I think the best way to learn anything in this world is to learn one-on-one with your teacher or your mentor. And that's why I do the one-on-one courses. I don't want to teach 5, 10 people at once. I just want to teach one person 2 hours a week for 10 weeks, everything that I know. And I promise you, if you decide to do this course with me, you will be a better trader when you're done. I promise you. I have taught hundreds of students. So if you're interested, my email is in the link of the description. Just reach out to me. Usually if somebody reaches out to me, then I say, hey, let's do a Teams call. It's a free call. It's not a sales call. I just want to learn more about you, your trading challenges, and your trading goals. It's a good time for you to ask me any questions about the course, and we can see if we're a good fit. All right. So it's worth every penny. It does cost $2,000, but that's 20 hours. It's a lot of time, you and I, of me teaching you what I know. So send me an email and we can start the process. Also, as an alternative, if you like online courses, I have a really good online course at udemy.com. The link's in the description. I teach you the deep dip buy stock trading strategy. It's 9.5 hours, really affordable, between $30 and $50. So that's a good alternative as well. And if you're interested in separate consulting, anything like that, I consult with a lot of people as well on a weekly basis. So I think that's really helpful. So reach out to me. I'd love to help you. And so let's get on to the potential trades for next week. Again, I only have 3. It's really strange. I went through my watch list last night and was like, God, there's just nothing here. But there's something, I guess. Berkshire Hathaway had some nice trades on Berkshire, but it's starting to look interesting again. So main thing here is this order block. Why is it an order block? Again, we have a swing low, we have a swing high, we have a lower swing low, we have market structure change. This defines the order block, the high and the low of the bar on 825. We move it into the future. And if we get back into this order block, okay, potential area to buy. Well, we did reject the high of the order block on Friday, but I don't want it there. The risk is too big. So what I am keying off of on Berkshire, 2 areas. We have the 250-day moving average. This is a deep dip buy major moving average. And then we also have the 300-day moving average. This is the orange line below. I always like to buy lower, but so for next week, if we reject, what I mean by reject is we go under, close back over, or close under, close back over, or bounce, that's a rejection. So potentially, if we reject the 250-day moving average, that's at 487.39. Or ideally, I'd like the bottom of the order block with the 300. The 300 is at 482.46. So that would give me a lower price and closer to the bottom of the order block. So a rejection of the 250 is a potential 487.39, or a rejection of the 300 at 482.46. So that's what I have potentially on Berkshire. INDA. You know, I had an order block here. Well, here, let's find it. Here's your bullish order block here. And I did have some trades on INDA, if you remember. But this just kind of shows you the strength of order blocks. And look, when we got to the order block, was it a good place to buy it? Yes, it was. When it got to the order block, was it a good place to buy? Yes, it was. Right? So, but here I'm not looking for a long position. I'm looking for a short position. You've heard me talk about abandoned babies. What's an abandoned baby? Funny name, right? Abandoned baby is this bar here. What makes it an abandoned baby? The previous day we gapped up. So the sentiment of the market that day was super bullish. Everybody had to buy it. It gapped up. But look what happened the very next day. We gapped down. When you have a gap up immediately followed by a gap down, that means you have had a very fast and dynamic change in sentiment. In this case, very bullish to very bearish. And when that happens, there's a lot going on under the surface to change something so fast. Now, when you have an abandoned baby, about 70+% of the time, you are going to continue lower. So, could I have shorted INDA here on the 23rd when it created the abandoned baby? I could, but I didn't. When you have an abandoned baby, the bottom of the baby, see the red line here at 55.11? That's going to be a significant resistance area. So I didn't go ahead and short, but I am waiting for a bit of a rally and back up to the bottom of that order block, 55.11, and rejection, meaning it tested it, closed below. If that happens, then very likely I will enter the trade. And on abandoned baby trades, if you've been watching my podcast, I make them pretty simple. I don't scale out. I don't do anything on these trades. I place a 2 ATR stop and a 4 ATR profit target. That's it. But look, we have a higher high than over here. Usually when you have a higher highs and you go down, you're going to have at least an attempted rally. So that's what I'm looking for on INDA. Yes, we have the abandoned baby, but I'm looking for a bit of a check back, an attempted rally, and a rejection of 55.11 for a short trade. So that's what I'm looking for on INDA. Let's talk about VIX. Well, I had a great trade on VIX. If you remember, I bought right here on the 7th. Why? 1, we're in an order block. 2, we rejected the high of the order block. 3, we went red-green on the Elder Impulse, which is exactly like abandoned babies. You go from very bearish to very bullish very quickly. That indicates you're probably going higher. And I bought here and scaled out all the way into that strength, and then closed here because got out here because we closed below the 5 EMA. So it was a great trade. But look, we are back in the order block again, the bullish order block. Now, could I have taken this trade on Friday? I could have. I didn't. Why could I have taken it? Because it rejected the bottom of the order block. So honestly, I just didn't see it. I may have taken it here. But going forward, what am I looking for? Either a close above the high of the order block, that would be a rejection of the high of the, that would be a rejection of the top of the order block, or if we head back down, go under the order block, and close back in the order block. So I'm looking for rejection potential of the high of the order block or the low of the order block. But, one thing about the market, I was warning over here, look, we're coming back into the bullish order block. Well, that was the top of the market. Now we're back in it again. Okay, we made all-time highs, but again, we're in the bullish order block. Doesn't mean VIX can't go lower and lose this order block, that's for sure. But it is something to be aware of, that we are in a very bullish area on VIX, which would not be bullish for the market. But we'll see, it could lose. But that's what I'm looking for on VIX, is a potential close above the high of the order block, or if we go back down under the order block and close back in it, that would be a rejection of the bottom of the order block. So I'm going to watch VIX very closely. Okay, so those the only three I have on the daily. Let's talk about the weekly. I only have one, everybody. Verizon. Verizon has had a very, very difficult time. We have earnings coming up, so I will not be taking any position prior to earnings, but the earnings are on the 29th of this. So after earnings, we could have a wild swing in Verizon. So again, I would wait for earnings, but what makes sense here on the weekly bars is Verizon. You have this very well-defined order block here on the 10th. The high is 37.73, the low is 35.78. But what do we have living right inside the bullish order block? Remember, the order block is bullish by itself, but I'm looking for a key entry point in the order block. Here's the 200-week moving average. This is a combination of deep dip buy along with order block. So maybe earnings come out and it goes straight up, great. But if earnings are disappointing and it comes down, this would be a very interesting place to look at, the 36.52 level. So that's $2.30 below, but it's possible it could happen. So that's what I'm looking for. And that's all I have on the week for you on the weekly bars here. So listen, everybody, I hope this was helpful for you today. If you have any questions, please put them in the comment section. I hope you have a good trading week next week. If I can help you with trading, either with a one-on-one course or private consulting, please reach out to me. Love to have you as a client, love to have you as a student. And again, if you have any questions or comments or anything you don't understand, put them in the comment section. I'll do my best to get back to you as soon as I can. Please be careful next week. Enjoy the rest of your weekend. I always like to leave off with, please try to go out and do something nice for another human being each day. In this crazy world, that would be something nice, right? We like it when somebody does something nice for us, an act of kindness for us. So why not try to go out and do it for another person, right? If you could try to go out and do something nice for an animal each day, if you have the opportunity, that would be great. It's good karma. They appreciate acts of kindness just like we do, right? So have a good weekend. Please be careful next week. Follow your process. And God willing, I will see you next week. So thanks so much, everybody. Have a really nice rest of your weekend. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.